Despite all the growth fears, stocks are near the highs heading into the thick of earnings season. Our next guest says it's rally on from here. Let's bring in Jeff Mills, the co-chief investment strategist at PNC Financial Services. Jeff, always good to see you.
Good to be here.
So we're so close to the highs right now. What's the next thing? I mean, will earnings send us higher? Will we see that new high within the next
I think they can.
period?
I mean, I think the market can eventually make new highs from here. You know, when I talk to our clients, both retail and institutional, I think there are two things keeping them from enthusiastically chasing this rally higher. And I think the resolution of those two things ends up being better than feared at the end of the day. So the one thing is the global growth slowdown, which obviously everyone's focused on. And the other one is earnings. So I think everyone now is anticipating fourth quarter earnings basically collapsing from current levels. And I think those two things are kind of inextricably linked. So from a global growth perspective, I've said it on the show before, you've seen further evidence of the China credit cycle bottoming. March data was better. Banks lent out a record number for the first quarter of 2019. And typically when you see the Chinese credit cycle bottom, about 9 months later, global growth bottom. So you look around August, you start to see better data out of places like Europe, for example. And that relates back to the U.S. markets because that helps U.S. foreign profitability. I actually brought a chart along with me. I don't know if they can throw it up on the screen, but it looks at composite China PMI versus U.S. foreign corporate profits. There's been an 85% correlation over the past 5 years. So if you get that bottoming in global growth, the support for foreign profits, then maybe earnings don't have to come down as much in the fourth quarter as people think.
So it sounds like you want to be all in on cyclicals. What sorts of cyclicals would you like at this point? And would you go with sort of the rah-rah, like tech, for instance, where we are at record highs, or would you go for the value cyclical, like, for instance, banks?
Yeah, we would probably stay away from banks here. And I think you kind of go with what has worked so far. And I think tech is one of those stories. You know, it's when you think about tech revenues, if you look at the biggest tech companies, 60% of revenues levered internationally, much more in the broad market. So more leveled to a global growth stabilization. I even like consumer discretionary here. You saw retail sales numbers. You saw unemployment claims, again, extremely low. And the fear there is that they're levered to rising wages. But what you've seen is unit labor costs actually come down because you've had a little bit of an uptick in productivity. So from a margin perspective, I think there's a little bit of protection there. So we're sticking with what has worked so far.
So, Jeff, when you laid it out, your premise, when you opened up here, you talked about China and you talked about when the credit cycle is worth buying and when it's troughed. But also, the marketplace has to have factored in China trade being resolved. Is that not in the market already? Is it going to be a sell the news event? In your opinion, at the very least, do you think that could be your headwind?
It could be, but I look at the China credit cycle and China trade as very separate things. And what I do think is if you get a trade deal that's a bit more comprehensive than the market thinks, you could actually have a little bit of a tailwind from trade. And if you look at companies that are not only levered to China trade, but also who do a fair bit of lobbying as it relates to trade, they've actually sold off a fair bit over the past number of weeks. So I think there was a lot of enthusiasm about a trade deal getting done. We've had this period to kind of drag on for a very long time. So some of that has come out of the market. Not all of it, but I think you get a little bit of a boost from China trade. And the credit cycle story is completely separate in my mind. And I think there's a clear trough in December. And I think we probably continue to go up from here.
So, Jeff, I'm going to give you a multiple choice. What worries you the most? What could derail this? So is it dollar, oil, Europe, or the Fed?
Four choices.
Four choices, yeah.
Or none of the above.
Or none of the above, or some of the above.
Ultimately, I think it's the Fed because that's done so much to support multiples. But I think the bar is so high for the Fed to actually hike rates right now. I kind of take that off the table a little bit. I'll point to Europe. I'll probably take that as my multiple choice answer because if you don't see that follow through in global growth and you don't see Europe start to pick up a little bit, we've seen good signs. You've seen economic sentiment indicators perk up a little bit, global PMIs bottom. But as much as I like the China credit cycle now, it tends to move in these 18-month increments. So if it actually bottomed in December, then you look to the second half of 2020 for that credit cycle to roll over again, then you have problems with global growth. And that's probably when the U.S. Probability for a recession perks up a little bit, too. So you could have the combination of those things playing together, and that could be a problem.
Jeff, great to see you. Thank you. Have a great long weekend. Jeff Mills of PNC. Guy, how do you trade this?
Well, I mean, the banks have had a decent run. I mean, the city's at $70. You haven't seen that in quite some time. But I think it's just a bounce off an oversold condition was $50 in December. So as much as I would like to like the banks, I think they've gotten a little ahead of themselves. And now they're all basically trading right around book value, which is probably what they should be trading
So
at.
you would fade the banks? If we were
I
to
didn't know we're
extend
playing
the
a
game.
game.
No,
Well,
we're
we
not.
keep
I'm
going
just
with
saying.
this. Games, and how about a multiple choice question?
I didn't know. Why you looking at me for
I'll
that?
give you 10 choices.
All right. Anyway, so Jeff talked a little bit about Europe. He talked it could be a fear. He also talked about the cyclicality of Europe, or else I will. Look at the DAX, which continues to break up. It broke the downtrend in February. It might be the best performing market in the world over the last couple of weeks. China, yes, I think actually the monetary kind of easing dies down a little bit. The fiscal easing and the stimulus, I should say, is starting to really kick in. So I continue to think EM and global cyclical and semis outperform.
So I do think that you obviously know what is going to hit me is the basically 2020 recession. So as constructive as Jeff is, it has to come, right? Recessions are normal. They're healthy. We always hear Tony Dwyer talk about that, and then no one wants to buy into them, or he says there's a window of period where you could still make money on it. So I think you have to stay away from the financials. I think you go with growth, and I think that's what the IPOs are telling us. People are reaching for growth at this point in the cycle.
All right.
For me, it just feels frothy right now. The IPOs, the fact that the market's not responding to good China news, the fact that the market responded a bit today to the good jobs number, but it was still a struggle. I mean, to me, I'm just very cautious. If I'm going to play anything, I buy China. That, to me, is where this is all coming from. So why not go right to the root of the cause?